And on to the long put calendar spread. The long put calendar spread is again going to be very similar to the long call calendar spread in that the thought process behind this is going to be that we are going to be trying to implement this strategy when there is low volatility. And if Vega expands, the short put in the short duration option will be negatively affected, but it will be offset by the positive effects of the Vega and the longer duration options. Because remember, we've said this before, Vega is going to affect the longer term options or the longer duration options a lot more than it's going to affect the shorter duration contracts. And the trader is creating this strategy that has defined risk and is looking for the underlying price to remain in a tight range, thus taking advantage of the theta decay in the near-term option, because the theta decay or the time decay is going to affect the front month a lot more than it's going to affect the back month. So in a perfect world here, we would like to see the Vega to slightly go to the upside in this, and in a put, you get Vega contract or Vega expansion rather quickly, especially in puts. It seems to affect puts because puts are downside correlated, and when you see sell-offs in the market, you really start to see the expansion in volatility happen. So in this perfect world, we'd like to see a bit of a sell-off and to see the time decay in the near term really take effect, and you would get it both ways. So the max profit will be heavily dependent on implied volatility contract as it expands or contracts. So as it expands, our max profit is going to go a lot higher. We do not want to see it go lower. And we would like to see Vega expand quickly upon this contract so that it can counteract what's happening to the theta in that long term. And when implied volatility expands, the theoretical max profit is incrementally better. The max loss is the debit paid for implementing this strategy. Remember, anytime you pay a debit, your max loss is defined. And the break even on the long put spread is similar to the max profit in that the break even will vary based on the change in implied volatility. Our break-even point is really going to be heavily dependent on that. And although it's vague, in this graph here, the break-even has a defined area, but as you hold this, or once you implement this strategy, this graph will fluctuate with the theta and the Vega movements. As theta contracts and Vega expands, you're going to see our break-even really move back and forth. As you can see at the bottom of this graph, we have the two strategies, one that looks like a legged strategy, one that looks like the calendar. I would always enter this as a calendar spread because, as I've said before, legging is for rookies, and rookies will always make a mistake and panic and leg into this at the wrong time. So just do it. Also, because the calendar counterparty is going to want the risk defined when they enter the strategy. Every pro out there knows that there is a lot of risk involved in that and is going to want to either collect a little bit more or pay a little bit less depending on what that risk is. So you will almost always get a better price by using the calendar. Yes, you will be able to leg into some things sometimes, but the ones that you leg into bad will eat up all of the profits you ever made legging into them good. So here you can see we paid 60 cents or $60 for this calendar spread, and the breakdown on it was basically buying the August 60 put at 201, so we collected that, and we sold the July 15 put or the near term put for $1.53. So the difference there is not 60 but it is just a representation. That would look like I legged it pretty good. Doesn't ever happen, believe me. I would probably have to adjust those prices in order to get filled for sure.
63 looks like it's pretty easy. I thought it was going to be by Friday, like I told Sell Puts, Killer, and everybody else on Twitter. But, maybe next week is when we're actually going to see that, all right? Take that. Then on to the bonds. Bonds, Ford, I got 141.04 is going to be support. Once the trail around this 140, 130 area, that's going to be your magnet. Resistance on the up end. I don't know if we're going to see that anytime soon just because equities are popping up. We're going to see a little bit of downward pressure in the treasuries. 142.19. All right? Sorry I missed you guys yesterday, but you know what I got to say? If you can't take that, take it easy.